It's spinning and we are started. So I'd like to introduce Home Loan Bill. We met on Twitter and we banter back and forth, and you are a loan officer out of Illinois, correct?
Yeah. Yep. Very, very small town in Illinois, about 13,000 people, but my office is in Peoria, Illinois, which is a little bit bigger than that. So we're doing well there.
I know Peoria.
Lots of cornfield.
Yes. And then you're licensed in Iowa too, I understand.
Yep.
And
yeah.
Your bank is also in Missouri, one of the largest.
So it's an independent mortgage lender out of Missouri. They're the number one lender, I believe the number one lender in Missouri, number one USDA lender here in Illinois. Actually, we're the number one USDA lender, I believe it was Illinois, Missouri, Oklahoma, and I'm missing a place. I don't remember where else that was.
Okay.
But yeah.
So basically, I've had a lot of questions with buying the first house, and I'll see it, especially on Twitter. It's really bad. Housing's so expensive. Yeah. I can't afford a house. We can, and I don't think any of them ever try to contact a lender and say, well, can I?
Right.
They can pay rent, that they can, do they really know what it costs to get into a house? So that's kind of the conversation I wanted to have with you. And I brought up two other people that asked questions on my page on, the USDA 0 down. And then FHA's got some 3% down. Conventional's got 5% down. So it's not as difficult to get into. So I thought what we may do is, let's say I'm a first-time home buyer and I give you a call. What do I expect? Where do I begin the process? I find you online and say, hey, Bill, I want to buy a house. What do I do?
Yeah. So typically, I mean, if they're calling and I'm going to find out if this is their first home or not. I work with mostly first-time home buyers. And so assuming that it's somebody's first time, then the question really just starts around, all right, so what are we thinking? What are we prepared for? What are we budgeting for? There's a lot of lenders that will take an application and based on whatever the parameters tell them that they can afford on paper, they'll pre-qualify them for, whatever amount of home that they're technically qualified for. Well, believe it or not, a lot of times what they're qualified for on paper is actually far exceeds what their budget is. And so you tell someone without having this conversation of, hey, what are your goals? What are your budgeting? That they're qualified for, let's say a $300,000 home, but they have no desire to spend anywhere near the monthly payment of what a $300,000 home is going to give them. And I've seen this happen multiple times where, they make an offer, that offer is accepted. And then they come to me and I'm hearing this for the first time. And I'm like, okay, so monthly payment's going to be this. And they're like, what? No one told me that. So
you mean they started shopping online for fancy houses and then
they use Zillow's monthly payment calculator, which is always wrong. So so it's one of those where my first couple of questions are, how long do you think you're going to live in the home? If you're going to buy a home, how long are you going to live there? Because, if they're saying, well, probably maybe, 1 or 2 years and then we're going to move out of state. It's like, all right, well, let's have a different conversation then. Let's talk about what their other alternatives are. I mean, if that's what you want to do, that's fine. But let's talk about what the potential loss that you could have by buying a house versus renting. But if they're, 3+ years, sometimes in some instances, 5+ years, but then we start, all right, let's start taking a look at what that's going to be. And so break it down just a couple of different questions. I say, how much can you afford each month? Well, and I take that back. Let me rewind. I usually ask them if they're renting, which usually they are. And then I ask them if there's any utilities included in that rent, and we kind of talk that out. And then I say, okay, is that a comfortable monthly payment for you? Or are you looking to increase, or are you looking to decrease? Tell me about what's going to be a comfortable monthly payment. And so they tell me what that is. And then I ask them, all right, so let's assume that you find a house that just checks all the boxes. You walk through the front door and you're like, oh my gosh, this is the house. But it's going to push you past your comfort level. What's the point at which you say, all right, for this house, I'm willing to pay this amount per month, but I'm not willing to pay another dime over this because my budget just can't handle it. And so I find out what the comfortable payment is, and then I find out what that max payment that they would want to afford. And then I pre-qualify them based on the max payment. even if they qualify for more, I don't set the pre-qualification letter to over that, because I want that conversation to be with their realtor that, all right, well, I want to go look at this house that's, $35,000-$40,000 over my pre-qualification limit. Then I want their realtor to be able to say, all right, well, then you need to go back to your lender and talk. And then we have that conversation and say, all right, so last time we talked, you said this was going to be uncomfortable, but now we're adding this much to your monthly payment. Is that something that you're coming to the realization that maybe there's not enough homes in the price point that you want, and so therefore you're willing to work some things out in your budget? Just trying to make sure that they're not, biting off more they can chew, running the new numbers for them, running new payments for them, and making sure that they're properly equipped.
Okay. So let me clarify this a little bit, because you and I, we've been in the business a long time, and we start to go down and we speak a language that a lot of these first-time home buyers may not understand.
For sure.
So the pre-approval letter is a letter that Bill will draft out for you, and it says, my client is able to afford a house at this price, and then you submit that, your agent submits that along with the offer you're presenting to that house. Mm-hmm. And what he's saying is he's going to put that number at a level you're comfortable with, rather than tipping the hat that you can afford more. And that's very important that he does that. But we don't have to go down that deep right now. Right now, Bill is kind of working on what you would be like. Let's say you're renting for $1,500 a month, and you're comfortable with that, Bill. That's kind of what I'm hearing you say, is then you would figure out how much house that $1,500 a month would buy based on, insurance and local taxes.
Yeah.
Kind of a rough price range. Then they can start shopping for the house based on that price point to target their payment, correct?
Yeah. I mean, so that's half of the conversation. The other half is, how much if you had to write a check tomorrow, and that check was to cover down payment, closing costs, inspections, insurance, realtor fees, whatever they may have to pay for. If you had to write a check tomorrow, how much are you comfortable writing that check for? And I say write a check because you and I have been in business long enough, but it's got to be in the bank, right? It's got to, like, you can't hide cash in a mattress or anything like that. So it's can't sell a truck. I mean, you can, but what's that?
It can't be Bitcoin yet, can it?
Yeah, well, so it can, but it's got to be liquidated, obviously. Bitcoin's so volatile, it's got to be liquidated before we can use it. But yeah, so what's interesting is that I find that and to kind of put the client at ease, I'll say something like, if you're just getting started and right now you're like, that number is zero, I have no dollars to spend, I couldn't write a check tomorrow for anything, then that's fine. But I just need to know where we're starting from.
Okay. So I'm the buyer and I come to you and I say, I'm paying $1,500 a month in rent. I'm comfortable with that. I've got a job, W-2 income, we'll make it easy. And then I have like $0 in savings. Now, what do you do?
So typically what I tell them is that, I mean, so this is what's true in my local market here. You're probably going to need to spend, you're probably going to need to save at least $2,500 or have access to $2,500, whether it be a gift from a relative, liquidation from a 401k or something like that, taking out from a 401k or some other retirement savings that you may have. But somewhere along the line, you're probably going to need roughly about $2,500 just to get us to closing. And then once we're there, the rest of the down payment, the rest of the closing costs, the rest of, whatever the costs that are involved, there could be opportunities for down payment assistance, negotiating for the seller to help pay for some of those costs. There's all kinds of things that we can do to try to make sure that we're covering the rest of the costs. But if they're coming to me and saying, I've got $0 and I can't get a gift from anyone, I don't have any funds anywhere else, in reality, it's usually one of those things where it's like, okay, we can try to do this, but I'm just being honest with you right now. This is honestly going to be pretty difficult. So I usually tell them that earnest money, that's, I mean, out of pocket expenses within the first 72 hours. I tell them earnest money's due in the first 48. And then usually in the next 24 hours after that, you're usually paying for an appraisal and then paying for whatever inspections is required, or not even required. I mean, VA requires a pest inspection, termite inspection, but no other agencies require any inspections. So the company I work for, we don't require any inspections unless the appraiser flat out asks for it. So,
Okay.
but most people want to get that home inspection, right? So I tell them, like, whatever the earnest money is, which is negotiable, but plan for at least 1% of whatever the purchase price is in a competitive market. That's probably a good place to be at. $500 for an appraisal. And then if you're planning on inspections, let's just plan on $500. And so if they're buying, basically like $150,000 house or $175,000 house, which is, that's first time home buyer price point in my market, right? They're looking at $1,500 for earnest money, $500 for an appraisal, $500 for inspections. So that's $2,500. And
Okay.
so,
Can you multiply that up? Because a lot of people are going to be, let's say 350 or 300. Let's just double everything you just said. So what
yeah,
is it?
pretty much. Yeah. So you honestly, in a lot of other markets, and it's also going to depend on, like, our title fees here, pretty cheap.
Mhm.
The farther north you get on Interstate 80, or north of Interstate 80 that you get here in Illinois, the more those title fees cost. And then if you get in like Cook County and stuff like that, they actually require you to have an attorney. Like, you have to have an attorney. You don't even have an option. So it's here, it's everything's scaled back a little bit. It's pretty low
Yep.
cost here, so that's good. But
So you're
yeah,
saying 2,500 minimum. So anyone in a non-rural market may want to just say it's 5,000 minimum.
yeah, probably. And again, there are some instances where you might be able to get away with, not having that much, but for the most part, I'd say 90% of buyers. So the way that I usually tell them is that at least 1% of the purchase price,
Yep.
that's probably where you want to be for savings just to get started. And then if you're eligible for down payment assistance, or if you're eligible for these other programs, and if you're able to negotiate for the sellers to help contribute and pay for closing costs, then perhaps we can get to closing with you not having to spend anything more out of pocket. But
Okay.
that's kind of where we're at for there. So
Okay. So now you run the approval process,
yep.
and what kind of credit scores do you typically need?
Well, so it's going to vary based on loan program. So, and lenders have different sort of, like, let me put it this way. So VA has their minimum credit score that they
Yep.
accept, FHA, conventional loans, right? They've all got their, but each lender is going to have different risk profiles that they like. And
Okay.
so
So
as
I
an,
come in, I've got an 800 credit score, and then boom, I'm going to go up to one type of loan product, maybe my best value, versus if I had like a 640, I may end up, this was
yeah,
much better revenue for you. So you
yeah.
kind of
And
start
so,
based on credit
so
score.
I've, the lowest credit scores that I usually tell people, it's pretty hard to get qualified under 600. Like, if you're under 600, it's pretty hard to get qualified. And honestly, there's a lot of times where, especially first time home buyers, there's a lot of times where their credit score may be low just simply because they don't have any credit. Like, they've got an old medical collection out there somewhere, but that's about it, right? So,
No credit's better than bad credit.
well, and what's interesting is that, I tell them, I'm like, listen, go apply for a secured credit card on Capital One, and throw that card in a drawer and forget it. Well, I usually say, do you have Netflix? Yes, I have Netflix. Okay, it's $20 a month. Cool. So set up automatic payments, which you already have set up out of your bank account.
Mm-hmm.
But instead of having it come out of your bank account, charge to the credit card, and then set up your credit card to get paid automatically, and throw that card in a drawer and forget about it. Forget it ever exists. Never cancel it. And in 6 months, you're going to have a credit score that you can use. And the longer you have that one card open, the better it's going to be. And I tell everyone this. I did that, I don't remember how many years ago. I can't tell you where the card is
Mm-hmm.
right now. And I mean, they send a new one every once in a while because it expires, and I just
Yep.
throw, like, again, I throw it in a drawer or whatever. But they keep increasing the limit, and it's like, again, it's $20 a month that I charge to it for something. I don't remember what it is now, but the longer you have that one account open, and a credit card's the best way to do it. It increases your score. So anyway, to get back to the point is that, anything under 600 is going to be difficult, not impossible, but difficult to get qualified. The door really starts to open up for opportunities right around 640, 660. That's usually when there's a lot more opportunities. And then anything over 700 gives you the widest range of options. So if you're over 700, that's going to give you the most range of options. But certainly I've qualified plenty of people with 602 credit scores or 620 credit scores. They may have to come up with a little bit of cash out of pocket on their own, but there are options. So.
Okay. So let's just pretend I'm at a 700 credit score. I have 5,000 in my market, 2,500 in a rural market.
Yeah.
And then where do we go? So we're going to buy a $150,000 or a $300,000 house. Is that, or am I jumping ahead?
So basically what I do is I run the numbers and try to see essentially, all right, so let's say you're comfortable with, a $3,000 a month or to $2,500 a month payment, whatever the case may be. So then I'll take the money that they say that they're willing to spend per month and put that basically the range that they say, what's the comfortable payment? What's the max? And then I take the amount of assets that they say that they can contribute towards this transaction, basically for down payment, closing costs. And then if we need assistance somewhere, then we find out where we're going to get that. So if it's negotiating for the seller to help pay it, then that's something that we put in the pre-qualification letter, because if we don't have enough assets ourselves, then we've got to get it from somewhere. So if they don't qualify for the loan unless they have enough assets to qualify, then we put that in the pre-qualification letter, so that obviously when agents like yourself are looking to negotiate, they see the letter and they say, okay, I know that I have to make an offer and it's got to have the seller credit attached to it. So, and then, a lot of times they get a gift from a relative, and that's completely fine as long as it's from a relative. And there's very specific ways
What
that
defines a relative? What do lenders look at for qualifying as a relative?
Yeah, that's a really good question. Is
it a moving target?
So let me say the way that I'm supposed to answer this is blood or marriage. If you're blood or marriage relative, that's what counts. So that's the way I probably should answer that, and I'm supposed to answer that. So that's how I'm gonna answer that. So
that's the general rules, and then obviously we got some not strange, but different dynamics of family. So yeah, then it becomes I get it.
Yeah.
Okay, so borrowing the funds for the closing costs. So now let's just say I'm interested in the 150 or the $300,000 house.
Yeah.
And what do I need for cash?
So it's going to depend. So a lot of times what I'll do is, so actually, can you share that?
Share that?
Yeah. Okay. So this is for my local market here. And so go ahead and scroll down just a little bit.
Am I
actually working? Let me see something here.
Are you able to control it?
Well, so I've got an option. So you can
add this to stage.
Yeah, there we go. So now I've got, so let me zoom in here. And so this would be like my local market here. So obviously the numbers may not jive with anybody else's market, and that's fine. But so let's assume for a second that we're looking at like a 3% down conventional, and the interest rates that you see here, these are based on what mortgagenewsdaily.com. They're not, I always pull that directly from there. So 3% down conventional, we're looking at, roughly speaking, about $1,668 per month, and cash to close is going to be just under about $12,000. Okay. Now this assumes that buyer agent commission has been agreed to be paid for by the seller. Okay. So all of these options assume that the seller is going to pay for buyer agent commission on these. And so what I do is I take them through this and say, all right, so here's the monthly payment breakdown. Here's your principal and interest payment. Here's what the estimated property taxes are. Welcome to Illinois. And here's what the estimated homeowners insurance is. Again, welcome to Illinois. A little bit more costly here than it is in Minnesota there, and a lot of other states. But and then obviously we've got mortgage insurance. Mortgage insurance, anytime that you put less than 20% down on the purchase of a home with a conventional loan, you're going to pick up something called mortgage insurance. It's a percentage based on your credit score on the loan amount. It'll go away after a certain period of time, but it's if you're putting less than 20% down, you're almost always going to have that unless you're a veteran and you qualify for a VA loan. So I show them where the monthly payment breakdown is and basically how we got to that. And then I tell them, so this is the amount of money right here. So $12,000 is what we need. So do we have $12,000? And a lot of first time home buyers are like, no, I don't have anywhere near that. Okay. So now it's an option of, all right, maybe we're in an area which around where I am, a lot of areas would qualify for, you spoke of it, like this USDA 0% down option. This is a good option for a lot of people. My personal mortgage, when my wife and I bought our first home 12 years ago, is a USDA loan. I joke that we got a mortgage back when interest rates hit 3% the first time. And so we've been on the same mortgage since, because there really wasn't any need to refinance. And so but yeah, so we this USDA, it's what's the best way to say this? Geographic specific. So the property has to qualify. So it has to be in a certain geographic location set by the USDA, and also it's income specific. So you have to have a specific income. You can't make more than a certain income, and that varies by county. So it's going to depend on whatever that is set for.
It's the percentage of the median income in that area.
Yeah.
And then it's also called a rural development loan. So if you're outside of the metro, you're probably, and there's a map that'll show you exact address, whether or not you're within this USDA boundary.
And now the tricky part about USDA is that with almost every other loan product out there, when something is based on income, it's based on application income. So let's say you've got husband and wife, but only the husband's going to be on the application. That's the only income that's being considered. For USDA, they consider anyone in the household who is working, anybody who's living in the household who's working. And so if you have a husband and wife, and maybe they've got their 18-year-old son who's living there as well and working, they want to know all of that income. And so that's where it can get a little tricky. But let's assume that we qualify. Then, as you can see, the monthly payment doesn't change. I mean, none of these monthly payments are too far off from each other. The one over there on the right is the most expensive. But as you can see, monthly payment doesn't change. But that cash to close, that does change considerably, because now we're only talking about $6,500 in costs, and that's what the closing costs are. And a lot of people would say, "Wow, that's a lot of closing costs." And in reality, what's interesting about this is that for this particular presentation, these are the costs that are for our market here locally, and the only thing that comes to Flat Branches, which is the company I work for, is $995 in this situation. So every other fee that's associated with this goes somewhere else. So title company, or it's going to your insurance company, or it's going to realtors, or it's going, whoever.
Well, no realtors are in this. That's still, we're assuming that's coming from the seller side of the transaction.
Yep, that's correct. So so then every other fee that's associated here is going somewhere else. And a big chunk of that is insurance, because you've got to pay a full years of insurance up front. And so I think I put this at like $2,100. So $2,100 of that is 1 year of insurance being paid. So, but yeah,
those are taxes and insurance. So you're going to use that money, and then they build the escrow.
Yep. So basically most of the time, especially for first time home buyers, your monthly payment is going to include taxes and insurance. And so every month you're going to make this full payment down here, and this portion of it, so the property tax and the insurance, goes into a separate account that is used annually to pay your annual taxes and your insurance costs every year. So it's basically like forcing you to save for those bills. And typically your mortgage servicer, whoever that is going to make those payments on your behalf. So, but yeah, so as you can see, we're starting here with, about 6,500. And so that's now there is an opportunity to negotiate for the seller to help pay for some of those costs. And so, and potentially even all of those costs, depending on the loan program. I don't want to get into the weeds that it gets a little tricky about how much you can negotiate for and what counts and what doesn't and all that sorts of stuff. So I won't get into the weeds too far into this video, but basically in this situation, you could hypothetically ask for the seller to pay for all of that. So you could make an offer for, let's say, 175 and ask them to pay for $6,500 in costs, but that still doesn't mean that you're not going to have any out-of-pocket expense, because essentially what it means is that when you get to the closing table, you may get some money back that you've already invested, but there's always going to be money that you're going to invest up front. Earnest money is the big one. Earnest money, what I just consider it to be an advance on your down payment. And so it's usually 1% of the purchase price, but it's negotiable. And then you honestly have, after that, you've got inspections. A lot of inspectors like to be paid up front. And then a lot of lenders will charge for appraisal fee up front as well. So inspections and appraisal fee, usually like $500 a piece. And so you're talking about $1,000 out of pocket there. If we're talking about 1% for the earnest money, we're talking in this instance, $1,750. So now we're talking $2,750 out of pocket. So that's why I'm saying, hey, it's probably a good idea to make sure that we've got at least $2,500, even if we're able to negotiate for the sellers to fully pay this amount. That doesn't take place until closing. And so, because they don't get paid until they get to the closing table. So it's good to make sure that we have at least enough money to get us to the closing table.
Okay, so let's say I don't find something in the rural area, and I'm going to go with the 3% down conventional or the 3.5% down FHA, and they're about the same on closing costs here. Can I ask for the seller to pay that full amount, or is there a limit on how much they can contribute?
Well, so there is a limit, but it like I said, it does get tricky. So since you asked the question, I'll kind of go into detail. So FHA and USDA loans, you're allowed to ask for up to 6% of the purchase price.
Okay.
And that will cover pretty much closing costs and what they call prepaid. So stuff that you were going to pay for anyway. So things like insurance, like that 4-year premium, stuff that would go to front your escrow account, prepaid interest, that kind of thing. So you can ask for up to 6% on the USDA and FHA. With conventional, it gets tricky. Because it's 3% of the purchase price for anything. If you're putting less than a 10% down payment, it's 3%. Anything over 10% is 6%. You can actually get all the way up to 9% if you put 25% down, but I've never seen that actually happen.
So. I didn't even know that existed.
Yeah, you can ask for 9% if it's 25% down or more. So, and then there's VA, and VA's, a lot of people will say VA is 4%, and that's not technically true. It's actually, they can pay for 100%. Sellers can pay for 100% of what those closing costs are. What they consider to be typical closing costs, in addition to 4% more than that. And so, and you might be asking, well, if they're paying for all the closing costs, and what more would they possibly, you can actually pay off debt. Like you can negotiate for them to pay off debt. So it gets pretty tricky. So it's, and like I said, I don't want to go down that rabbit hole, because that gets pretty wild. But for veterans, there's a lot of stuff they can do.
How important a good lender is to work with. If you're a first-time home buyer, your lender is going to be your partner on this, and same with your agent, to navigate you through all the options you have.
Yeah,
you're not negotiating with your lender or your agent. You are using them as your team to find the best options for you out there.
Yeah. Yep. And so the last option here is it's a local down payment assistance option here. And so it offers 10% of the purchase price up to $10,000 that you pay back monthly over the course of 10 years, interest free. And so what you're looking at here, and the reason why this is a little bit more, is exactly $83 a month more than over on this side over here. And the reason for that is because you have that extra, actually I can show you. There's that $83 per month second mortgage. And so you're borrowing basically $10,000. It's a state down payment assistance that we have here. You're borrowing $10,000 from the state. You're paying it back monthly over the course of 10 years. And then once that's paid off, obviously that goes away. But that helps assist you with bringing those costs down even further, assuming that we're not negotiating for the sellers to pay for any of those. So in this instance, instead of having to bring almost $12,000 to close, or $6,500, now we're down to almost $3,800, $3,700. So those down payment assistance programs can help. There's pros and cons to those, though, because you've got this outstanding second loan out there, and as you can see, we bought the home for $175, but the total loan is $179, almost $180. So we have almost $5,000 upside down on this home the moment we walk into it. So It has its advantages, lowers our cost out of pocket, but it also means we've got some time before we've got some equity in the home, and potentially even before we can refinance, because we can't refinance until we have enough equity to either pay off both the mortgages, or you're willing to bring cash to close to the refinance. So there's pros and cons for the down payment assistance options.
Yeah. So just to explain to the listeners, the down payment assistance, it's usually administered by Housing and Urban Development, will give states large blocks of money. And then these states will figure out how to disperse that to their targeted audience on who, first-time home buyers is the target audience. And then they will set up parameters. So it takes a lender that knows that market to find out how to qualify for these different programs and who administers them. Some are done through the state and some are done through the cities. And then sometimes private groups that also contribute money.
And you brought it up. You brought it up, and I'm just going to say this, and hey, this isn't live, so you can decide to edit this out if you want to, but
no, it all stays in.
I all stays in. All right, whatever we say, that's it. Listen, if you are a first time home buyer, I'm pleading with you, don't call some spaceship mortgage company or anything like that.
Frozen words, and I agree with that statement.
Yeah. And here's the reason why. Listen, I'm sure that there's a lot of really fantastic people that work there who are great loan officers. But if you're a first time home buyer, you really want it boots on the ground. Somebody, I have a personal saying, and this is something that I tell realtors here locally as well as clients here locally. I say, don't ever accept a pre-qualification letter from someone that you can't drive 10 minutes and punch them in the face. And the reason for that is because imagine investing $500 for an appraisal, $500 for inspections. You've hired maybe you've hired a moving company, or maybe you just asked for the weekend off of work, or whatever the case is, and you've got all this set up, and a week before closing, the lender comes to you and says, "Oh, you don't qualify. We're sorry. You're no actually closed on this home. You've already told your landlord you're moving out. You've already got it, friends planning on moving. You got things boxed up," and they say, "Yeah, you don't actually qualify."
This is stuff that the lenders and your agent and the seller's agent all contend with. And when they don't see a local lender, everybody gets nervous, because when things go bad, they really go bad.
So. Well, the reason that I say that is that if you're talking with a lender that is obviously if they're working in several states away or something along those lines, and there's no accountability to the local market, then they're not going to get business from the local market. And so the way that local lenders are able to get business is because they have a good reputation. Realtors are not going to pick them if they're not good at closing loans, if they're not good at thinking outside the box and solving unconventional or having unconventional solutions to problems. So we make our living by making sure that we are treating our community well and that we're doing the best thing for our community. And again, that's not to say anything negative against any of these large, spaceship mortgage companies, right? So choosing my words carefully there, but again, there's probably a bunch of really great loan officers that work there, but they have no skin in the game. They have no skin locally, and a lot of them don't know, to your point, they don't know about the local down payment assistance options that are available in your state or your county or even your town. Sometimes they can offer that assistance. So a lot of times you're flying blind with a lot of those other companies, and that's why you really do want to go with a trusted local person. If you're worried about hey, I want to make sure I'm getting the best deal, and I don't want to be referred to someone by someone who might be getting kickbacks, which is the thing I hear all the time. Well, then fine. Find a friend of yours who purchased a home, ask them how their lending experience went, and they said, oh, it was great. Go with that guy. So
your referrals are usually your best source.
Yeah.
Your friends and family who they worked with and had a good experience with. So
absolutely.
Yep. Okay, so these buyers, they have a lot of options.
I mean, the higher your credit score is, and the more assets you have, the more options you have. But the good news is that even for people that don't have a lot of money saved, and even for people whose credit scores may not be as high, there are options that are available to them as well. So,
okay. So now let's just multiply this by 2.
Yeah.
So now we're going to go 350,000 instead of 175. Can you do that? Can you hit that button?
Actually, I can. So let me get over here. So so
not
this
is as expensive as Illinois. So some of your closing costs will be a little cheaper depending on what state you're in.
So let's see here, and we do. So yeah, we're. Let me. Sorry, I'm going to 1.2. Let me just increase that to 225. All right, and the rest of that should translate just fine.
Okay, so that's the conventional at 300, loan amount 291. Okay.
And I don't want to do that. I want to do, there we go. Now the down payment assistance one gets ugly here because there's actually a fee for the down payment assistance that we don't charge, they charge, right? And that fee is 1% of the loan amount. And so obviously when you have 1% of the loan amount and that loan amount gets up there in the 300,000 area, obviously that fee gets more and more costly and renders the down payment assistance less and less useful. So, okay. So there, just for the sake of brevity here in time, it's not going to translate perfectly, but this is roughly speaking. So, as you can see, monthly payment. Oh, no, I got to go here. Monthly payment went up a little bit. Obviously, cash close goes up based on just simply because we're paying more for the down payment, things like that. But this is roughly speaking, just what you would see here in Illinois. If you're looking at about a $300,000 house and you're looking to put, just the minimum down, then this is kind of what you're looking at here.
Okay. So it's about $2,800 a month for a $300,000 house, and about $1,700 a month for 175.
Yeah, roughly speaking. And again, so the homeowners insurance, again, I put that up a little bit here because obviously that's there's a lot of wind here, a lot of wind and a lot of roof damage and everything else. So, and then that's welcome to Illinois taxes. That's the big one right there. So,
okay, let's do $2,250 a year in taxes.
Okay, yeah, absolutely.
That's more Minnesota style, and I think that's going to be probably pretty fair across the country. So I'll just call it like 188. Just call it 190 a month.
Okay. All right, so
I think that should be a little more typical of the rest of the country.
All right, so that should drop us down there a little bit, and so obviously that's going to
that explains why the house prices are cheaper there.
Oh yes,
because it's the monthly cost of the house, so the house prices have to be cheaper to afford that tax.
Precisely, and it's the same thing that I tell. I mean, if you picked up my house where it is and just dropped it somewhere like in Missouri as an example, they got relatively low property taxes there. It would double if not triple in value just because of where the property taxes are. So yeah, people talk about home affordability all the time. This is stuff that you and I see on Twitter all the time where people they go crazy about, oh, home prices, home prices, home prices. Listen, home prices, if the number one thing that I can tell anybody who's looking to buy their first home, don't freak out about the home price. And if you're trying to get a deal, don't negotiate for the price of the home. That's the last thing that's going to save you money. The best thing that you can do to save money if you're trying to negotiate is negotiate for seller credits, negotiate for the seller to pay closing. That's how you save money if you're a first-time home buyer. If this is your second or third home, you've got a lot of equity, things like that, yeah, go ahead and negotiate for a lower price if you can in those markets. But yeah, there's no point negotiating over the price of the home. I think here locally, I tell people, you get $1,000 off the price of the home. Congratulations, you just saved yourself $6. And so if I were to tell you, hey, I'll give you $1,000 right now, or I'll give you $6 a month for the next 30 years, what do you prefer? Everybody in the world saying, give me the $1,000 now. I mean, $6 a month does nothing for me. So, I mean, so just consider that whenever you're negotiating, and obviously your realtor is your negotiation expert. I'm just the number guy who gets really mad every time I see.
They go hand in hand, and a lender and a realtor that work well together is important.
Oh, absolutely. So, I have locally here, I have some of the best buyer agents that I work with, and they get this cost analysis as well. And so they're prepared when they go to write offers. They know exactly what they're writing for. And as long as everyone's on the same page, then that makes the negotiation process pretty darn easy. So.
Okay. So now that we scared them with a $20,000 cash to close.
Yeah.
The same scenario works through 3%, 6% seller contributions, 0 down program. You can get some of that paid for. So the same concepts work. We're just dealing with different numbers in a different area.
Yeah. And let me correct something here real quick, because there's, so one of the things that didn't translate was I have the realtor commission set in here as 3%, but I had the contribution from the seller paying for it set at a fixed amount. So let me remedy that here real quick, because the costs are going to be different.
I thought the realtor commission was left off of this.
So because so the way that it works is I have to disclose it.
Yeah.
Because it is a cost. But what I do is I leave it on. I also put a contribution on here from the seller to show that in this instance, the seller is paying for it.
So you show the cost and you show the credit back, so it balances out.
So since when I adjusted the purchase price there, the commission went up, but since the contribution that I had in the system was a fixed dollar amount, it didn't translate. So now it's to where it's supposed to be. So,
okay.
Yep. Hopefully that makes more sense.
That's a lot less scary.
Yeah, it's less scary. So,
okay. But this is a prime example of what you've been hearing about the National Association of Realtors settlement and what the Department of Justice. They want to see that commission all get piled on the buyer side of the ledger. And then they're going to claim that the commissions are coming down because now the seller's only paying their half of the commission. And then the buyer's paying their side of the commission. That's not the way it's operating yet. But, this is the perfect example with the way it's operating today. So,
and I honestly, my opinion on that is that I think that, I mean, it's gonna be market dependent, right? But it's a pretty big seller's market here. I mean, we're median days on market, I wanted to say last month was something like 12 to 17 days or something along those lines. I mean, it's pretty wild here, and sellers are, the first domino to fall in all of the housing market is the first-time home buyer. If the first-time home buyer can't buy a home, the move-up buyer can't buy their home. They've got to sell to buy most of the time. So it's, in my opinion, first-time home buyers most of the time probably won't have an issue with negotiating for the seller to pay for that commission. Move-up buyers, that might be a different story. So
Yep, that's the way it's working today. So yep.
Yeah.
And then so how much cash am I going to need now? How much can I negotiate out of the seller to cover that? Can I get these? How low can I get these?
So for the conventional side, you can negotiate for $9,000. So at that point, you're looking at what, 7,000? Yeah. roughly. What am I doing there? 8,000. No,
8,000. Yeah.
8,000. There it is. And then, yeah, well, close to it anyway. And then over here, you can actually do 6%. So you can negotiate for $12,000, and so that would reduce that cost somewhat. It's interesting. You can only negotiate for as much seller credits as there are closing costs. So, in the example of this is that let me just unhighlight these here real quick. So obviously, if you negotiated for a $9,000 seller credit, you have to spend at least $9,000 because it's a 3% down conventional option. It's a $300,000 home. You have to spend at least $9,000 out of pocket. The seller can't pay for your down payment. So in this instance, you actually can only negotiate for $7,200.
Yep.
Right, because you have to pay for at least $9,000 out of pocket. So
which can come from a family, right? Gift letter.
So it can, as long as you qualify for that. It's weird. Sometimes the assets, I won't go into detail. Basically, it's not 100% of the time that you can just get it from a family member. Sometimes it's got to be your own funds. Most of the time, you can get it from a relative. We'll just leave it at that.
That's why lenders don't like me paraphrasing and trying to oversimplify the program, because it's very complex what they have to navigate.
And it's one of the things that I'm actually, I don't think robots are coming for my job anytime soon. It's one of these things where whenever you got government involved and you've got all these different regulations and options that you have to navigate through, listen, I'm very confident that I'm going to be in this job for a while. So, and maybe I'll be eating my words 10 days from now when some new technology breaks out. I don't know, but as of right now, I have
no two buyers that are the same, and there's no two houses that are the same. It's dynamic.
Yep. So yeah, so that's pretty much what we're looking at.
So if someone's got questions, how do they reach out to you?
Oh gosh, so www.homeloanbill.com is my website. That's got all my contact information on there. But again, I would stress that if you're up where you're at, if you're in Minnesota, call somebody there. Like that's the biggest piece of advice I can give you. Find boots on the ground in your local market and find out whoever has the best reputation there. Give that person a call, because that's who you want in your corner when boots on the ground, that kind of thing. So.
Yeah, that's good advice. But they still may want to follow you on Twitter. And how do they find you on Twitter?
Yep, at Home Loan Bill. So
yeah, and you can join in our banter. So
yeah, exactly. And yeah, I'm not a great follow on Twitter. I get triggered too easily. So
all right. Well, I appreciate you jumping on. This is very insightful. So this is not out of reach for most people. There are ways to overcome this, and the first step is to call a realtor and a lender.
Yeah, absolutely.
Cool. Awesome. Well, thanks, Bill, and we'll get this posted, and we'll see if people have questions.
All right, sir.
All right. Thank you.
Yeah, take care.